What if I told you that the single greatest advantage in the stock market doesn't belong to the Wall Street analyst with 3 computer monitors and a PhD in finance? What if that advantage belongs to you? What if the secret of finding the next monster stock, the next 10-bagger, isn't hidden in some complex algorithm, but is waiting for you at the mall, in your grocery cart, or at your kid's soccer game? It sounds too simple to be true, doesn't it? We're taught that investing is a complex, dangerous game best left to the professionals. We're told we don't have the time, the knowledge, or the skill to compete with the big institutions. But what if that's all a myth? What if the professionals are actually at a disadvantage, and your everyday experience as a consumer and a worker gives you a powerful, built-in edge? There was one man who not only believed this, but proved it on the grandest scale imaginable, becoming the most successful mutual fund manager of all time. He didn't do it with a secret black box. He did it by investing in companies he understood, by visiting the stores, by talking to customers, and by applying a set of powerful, common-sense principles. Welcome to Capitura. Today, we are exploring the most empowering and accessible investment book ever written. We are taking an audiobook-style journey through the guide that turned millions of ordinary people into extraordinary investors. One Up on Wall Street by Peter Lynch. This isn't just a book summary. It's a declaration of independence for the individual investor. Stay with us, because the ideas in this book will give you the confidence and the tools to beat Wall Street at its own game. Introduction: your edge over the experts. Peter Lynch is not just another author. He is a Wall Street legend of the highest order. From 1977 to 1990, he ran the Fidelity Magellan Fund. When he took over, it was a small, obscure fund with about $20 million in assets. When he retired just 13 years later, it had grown over $14 billion, and Lynch had become the most famous money manager in the world. His track record is the stuff of legend, an average annual return of 29.2%. To put that in perspective, a $10,000 investment in his fund in 1977 would have been worth over $280,000 by the time he retired. He didn't just beat the market. He absolutely demolished it, and he did it year after year. But what makes Peter Lynch so special, and what makes this book so revolutionary, is his core philosophy. He passionately believed that the average amateur investor has a significant advantage over professionals. Why? Because the professionals on Wall Street live in an insular world. They are often bogged down by bureaucracy, forced to invest in a limited universe of large, well-known stocks, and they are constantly worried about short-term performance. You, on the other hand, have the freedom to invest in any company, big or small. You have a long-term time horizon. And most importantly, you have on-the-ground, real-world knowledge. You are the first to notice when a new restaurant chain like Chipotle has lines out the door. You are the first to see that every teenager is suddenly wearing Lululemon leggings. You are the first to discover a great new product at your local hardware store. This local knowledge, Lynch argues, is the amateur's secret weapon. You can spot the next great growth story years before it shows up on a Wall Street analyst's radar. This message is more relevant and more powerful today than ever before. We live in a world of consumer-driven trends that can create explosive growth for companies. Think about the rise of Tesla. You didn't need a fancy Wall Street model to see that something special was happening. You just had to open your eyes and see the cars on the road, talk to the passionate owners, and recognize the power of the brand. That was your edge. This philosophy stands in stark contrast to the speculative manias we see today. Lynch's approach is not about chasing meme stocks based on a Reddit post or buying a cryptocurrency because of FOMO. That's gambling on price movements. Lynch teaches you to be an investigator, a scuttlebutt researcher. He wants you to find a great business first, and then look at the stock. His method is the perfect antidote to the casino-like atmosphere of the modern Robinhood culture. Even for those in FIRE movement who primarily use passive ETFs, Lynch's wisdom is invaluable. He provides the tools and the confidence for those who want to go beyond passive indexing and build a satellite portfolio of individual stocks, potentially turbocharging their journey to financial independence. One Up on Wall Street is not a dense academic textbook. It is a folksy, anecdotal, and incredibly practical guide filled with amazing stories of the 10-baggers, stocks that go up 10 times in value, that he found in the most unlikely places. This book will change the way you see the world around you. Every store you visit, every product you use, every trend you notice will become a potential source of investment ideas. It's an empowering message that tells you that you have all the brains you need to succeed in the stock market. You just need a framework for thinking, a bit of research, and the courage to trust your own judgment. In the chapters that follow, we will break down Peter Lynch's entire investment process. We'll learn how to find great ideas, how to use his 6 categories to classify any stock, what simple numbers to look at, and when to buy and sell. And after each chapter, we'll connect his timeless advice to the stocks and the market of today. This is your playbook for becoming a superior stock picker. Let's begin. Part 1. Preparing to invest. Chapter 1. The making of a stock picker. Peter Lynch begins his book not with complex theories, but with his own origin story, which is essential to understanding his philosophy. He didn't come from a wealthy family or a long line of financiers. His journey started as a young boy, when his father passed away and his mother had to go to work. Lynch started caddying at a local golf club to help out. This, he says, was the best education he ever got. Why? Because the golf club was frequented by a host of successful business people and stock market investors. As he carried their bags for 18 holes, he didn't just get paid, he got an education. He listened to them talk about their businesses, their industries, and the stocks they were buying. He heard them discuss successes and failures, and he started to connect the dots between the performance of a real-world company and the performance of its stock. He learned that behind every ticker symbol was a real business, with real products, real customers, and real profits. This was the foundational insight of his entire career. His first big investment came from this experience. While caddying, he overheard talk about a company called Flying Tiger Airlines, an air freight company that was booming due to the Vietnam War. He did his own research, his first act of Scuttlebutt, and was impressed. He invested the money he had saved from caddying and from a scholarship, and the stock became a multi-bagger, funding his graduate school education. The lesson was seared into his mind. A little bit of research and a good story could lead to spectacular results. He goes on to describe his time at the Wharton School of Business, where he found that the academic theories of the market, the efficient market hypothesis, modern portfolio theory, were completely at odds with his real-world experience. The academics taught that you couldn't beat the market, that all information was already priced into stocks. But Lynch had already done it. He knew that the market was not perfectly efficient and that an individual who did their homework could find incredible bargains. This chapter sets the stage for the book's core, empowering message. Investing is not an esoteric science reserved for a priestly class of academics and professionals. It is a practical art form that is accessible to anyone willing to do a little bit of legwork. Lynch is demystifying the market, telling the reader, "I was just a regular guy who started as a caddy. If I can do this, so can you." Modern takeaway. Lynch's origin story is a powerful antidote to the sense of intimidation many people feel about the stock market today. The modern financial world is filled with complex jargon, intimidating charts, and experts who make it seem like you need a PhD to participate. Lynch's story tells us that the most valuable information doesn't come from a textbook. It comes from the real world. A modern-day Peter Lynch might not be a caddy. They might be a video game enthusiast who noticed the incredible popularity of Fortnite or Roblox long before Wall Street did. They might be a software developer who realized the revolutionary potential of a company like Snowflake or Datadog because they were using their products at work. They might be a parent who saw that every kid in their neighborhood was suddenly obsessed with a new toy or a new social media app. The lesson of this chapter is to value your own unique experience. Your job, your hobbies, and your daily life give you a specialized knowledge base that the professionals on Wall Street don't have. They are sitting in an office in New York, looking at spreadsheets. You are on the front lines, seeing the trends as they emerge. That is your edge. Don't be intimidated by the experts. As Lynch's own story shows, sometimes a caddy knows more than the CEO. Chapter 2, The Wall Street Oxymorons. In this chapter, Peter Lynch takes aim at the professional investment industry and argues, with his characteristic wit, why the amateur investor has a powerful built-in advantage. He calls the term professional investor an oxymoron, a contradiction in terms, because the structured professional world often forces them to act in ways that are detrimental to long-term returns. He lists several reasons why the pros are at a disadvantage. Institutional constraints. Most fund managers are not free to invest in whatever they want. They are often restricted by their fund's charter to only invest in certain types of stocks, e.g., only large-cap S&P 500 companies, or are forbidden from investing in small, unproven companies. This means they are forced to miss out on the small, fast-growing companies where the truly explosive gains are often found. Groupthink and bureaucracy. A professional analyst often has to get their ideas approved by a committee. This process tends to weed out the bold, unusual, and contrarian ideas in favor of safe, conventional ones. It's hard to be a lone wolf when you work in a pack. Obsession with short-term performance. Fund managers are judged on their quarterly performance. This intense pressure forces them to think short-term. They can't afford to buy a great but temporarily out-of-favor stock and wait 2 years for it to work out, because they might lose their job in the meantime. The amateur, on the other hand, has the luxury of true long-term thinking. Size. A giant fund like Lynch's Magellan Fund eventually became a victim of its own success. When you are managing billions of dollars, it's very difficult to make a meaningful investment in a small company. Even a huge win in a small stock will barely move the needle on a massive portfolio. The amateur, with their small pool of capital, can make a life-changing return on a single small-cap 10-bagger. In contrast, the amateur has none of these constraints. You can invest in any company, of any size, in any industry. You don't have to answer to a committee. You are not judged on your quarterly performance. And your small size is your greatest asset, giving you the agility to get in and out of small, fast-growing companies that the big funds can't touch. Lynch's message is a rousing call to arms. Stop thinking of yourself as a little guy who can't compete. Start thinking of yourself as a nimble, independent operator who has the freedom to run circles around the institutional dinosaurs. Modern takeaway. The disadvantages Lynch describes for professionals have only intensified in the modern era. The pressure for short-term performance is relentless. The rise of 24/7 financial news and social media means that every fund manager is under constant scrutiny. Think about a professional fund manager in 2020. They might have personally believed that Tesla was a wildly overvalued cult stock, but as the stock kept soaring, their fund, which didn't own it, would have been massively underperforming the index. The pressure from their clients and their bosses to buy the stock just to keep up would have been immense. This is called career risk. Many professionals are forced to buy overvalued stocks they don't believe in, simply because not owning them is too risky for their career. The amateur investor has no such pressure. You can patiently wait for the bubble to pop. The size constraint is also a huge factor. A massive modern fund, like a large ETF or a multi-billion-dollar mutual fund, simply cannot buy the next great micro-cap software company. Their only option is to wait until it's a multi-billion-dollar company itself, by which time the initial 10x or 20x return has already been made. That return is available only to the individual investor who is willing to do the research and get in early. This chapter is incredibly empowering. It flips the script. It tells you that your status as an amateur is not a weakness. It is your superpower. Chapter 3. Is this a good market? Please don't ask. This chapter tackles one of the biggest and most useless distractions for the individual investor. Try and predict the direction of the overall stock market. Lynch argues that trying to forecast whether the market is going to go up or down in the short term is a complete waste of time and mental energy. He confesses that in his 13 years of running the Magellan Fund, he never once made an investment decision based on a forecast of the macroeconomy or the stock market. Why? Because the experts who make these forecasts are almost always wrong. He jokes that if you get 10 economists in a room, you'll get 11 different opinions, and all of them will be wrong. The future is inherently unpredictable. There will always be 1,000 reasons to be worried. Recessions, inflation, interest rates, elections, geopolitical crises. If you wait for all the uncertainty to go away, you will never invest a dime. Lynch's core philosophy is bottom-up investing. He doesn't care about the big picture. He cares about the small picture. Is this individual company I'm looking at a great business, and is its stock available at a reasonable price? He believes that if you own a portfolio of great, growing companies, they will do well over the long term, regardless of what the overall market does in the short term. A great company will find a way to thrive through recessions and market panics. He points out the folly of selling everything because you think a crash is coming. He shows data that market declines are a normal and recurring feature of investing. Since 1900, the market has had dozens of corrections, declines of 10% or more. Trying to time these declines is a fool's errand. You're likely to sell too late, and more importantly, get back in too late, missing the powerful recovery that inevitably follows. More money has been lost by investors trying to anticipate corrections and getting out of the market than has been lost in the corrections themselves. His advice is simple and powerful. Stop worrying about the market. Stop listening to the forecasters. Stop reading the scary headlines. Instead, focus all of your energy on finding great individual businesses. If you do that, the market will eventually take care of itself. Modern takeaway. Lynch's advice to ignore macro forecasts is more critical now than ever before. We are living in an age of information overload. Every minute of the day, financial news channels like CNBC and social media are filled with experts predicting the next market crash or the next recession. This creates a constant state of anxiety and encourages short-term, emotional decision-making. Think about the COVID-19 crash in March 2020. The world was shutting down, and the headlines were terrifying. Every forecaster was predicting a new Great Depression. An investor who listened to this macro fear would have sold all their stocks at the absolute bottom. A Peter Lynch-style investor, however, would have ignored the noise. They would have said, "This is scary, but I own great companies like Amazon, Microsoft, and Google. Are these companies going out of business? No. In fact, some of them might even benefit from this stay-at-home world." They would have held on, and perhaps even bought more, and would have been handsomely rewarded by the spectacular market recovery. The same applies to the constant chatter about what the Federal Reserve is going to do with interest rates. Amateurs and professionals alike waste countless hours debating this. Lynch would say this is a waste of time. You have no control over it, and you can't predict it. Instead, spend that time researching a company. Find out if its earnings are growing, if it has a strong balance sheet, and if its new product is a hit with customers. That is information you can actually use. This chapter is a call to liberation. Free yourself from a useless and anxiety-inducing game of market forecasting. Chapter 4. Stalking the 10-bagger. This is where Lynch introduces his most famous concept, the 10-bagger. The term, which he borrowed from baseball, where a 4-bagger is a home run, refers to a stock that goes up 10 times in value. A $10,000 investment that becomes $100,000. These are the life-changing investments that can make a portfolio. Lynch's entire philosophy is geared towards finding these incredible winners. He argues that 10-baggers are not as rare as you might think, and they are most often found in the category of small, fast-growing companies. A giant company like Coca-Cola is not going to be a 10-bagger. It's simply too big to grow that fast. But a small, innovative company with a great new product and a huge market to expand into has a potential for explosive growth. So, where do you find these companies? This is the heart of Lynch's by what you know philosophy. He says you can find them everywhere. The key is to keep your eyes open and to think like an investor in your everyday life. He calls this process stalking the 10-bagger. It begins not with a stock screen or a broker's report, but with an observation in the real world. You are at the mall and you notice that a new store, like the Limited or the Body Shop in his day, is absolutely packed with customers. This is your first clue. You are a doctor, and you realize that a new medical device from a small company is revolutionizing a certain procedure. This is your professional edge. Your kids are obsessed with a new video game or a new brand of sneakers. This is a powerful signal of a consumer trend. This initial observation is just the beginning. It is not a signal to buy the stock. It is a signal to start doing your homework. Lynch calls this a Scuttlebutt method, a term he borrowed from another legendary investor, Philip Fisher. It means doing on-the-ground, investigative research. Once you've identified a promising company, you should visit the stores, talk to the employees, try the product yourself. Is it really that good? Ask yourself, why is this company successful? What is its story? Is there room for it to grow? A single successful store is interesting, but the real 10-bagger potential comes from the company's ability to replicate that success across the country or around the world. Lynch provides numerous examples from his own career where he found a 10-bagger simply by noticing something in his daily life. He discovered Hanes because his wife loved their legs pantyhose. He invested in Dunkin' Donuts because he was impressed by their coffee. He is teaching the reader to turn their everyday world into a hunting ground for great investment ideas. Modern takeaway. The world today is overflowing with opportunities for a Lynch-style scuttlebutt investor. The rise of the internet and social media has made it easier than ever to spot and research emerging trends. The rise of streaming. You might have noticed in the mid-2010s that all your friends were canceling their cable subscriptions and signing up for Netflix. You might have been impressed by the quality of their original content. That was a powerful clue to a massive consumer shift. The energy drink boom. A decade ago, you might have noticed that every college student and construction worker was suddenly drinking Monster beverage cans instead of coffee. A little bit of research would have revealed a company with explosive growth that went on to become one of the greatest 10-baggers of the century. The e-commerce niche. You might have discovered Etsy because you were looking for a unique, handmade gift and were impressed by the platform and its passionate community of sellers and buyers. This was a clue to a powerful and profitable niche in the e-commerce world. Lynch would be thrilled by the modern investor's toolkit. You can use Google Trends to see if a brand is growing in popularity. You can go on Reddit forums or Twitter to see what real customers are saying about a product. You can download a company's app and see how it works. The opportunities to stalk the 10-bagger are everywhere. This chapter is a call to action. Start paying attention. Your next great investment idea might be right in front of your face. Chapter 5, The Good, the Bad, and the Invisible. In this chapter, Lynch reinforces the idea that you should only invest in stocks if it's the right choice for your personal financial situation. He starts with a blunt warning. Only invest what you can afford to lose without it affecting your life. The stock market is volatile, and there is no guarantee of success. You should never invest money that you might need for a down payment on a house in the next year or for your kids' college tuition. He lays out a simple checklist of personal finances that you should have in order before you even think about buying your first stock. Do you own a house? Lynch is a big believer in home ownership as a primary, foundational investment for the average family. Do you have your finances in order? You must be living within your means and have a clear understanding of your budget. Do you have the personal qualities to be a successful investor? This is a crucial psychological point. Lynch says you need patience, self-reliance, common sense, a tolerance for pain, because you'll have losing stocks, and the ability to admit when you are wrong. If you are a panicky, anxious person who needs instant gratification, the stock market is not for you. He then gets back to the idea of the amateur's edge. He argues that you should not feel pressure to invest like a professional. You don't need a portfolio of 100 stocks. You don't need to be in the market all the time. He says that it's perfectly fine to have just 1 or 2 great ideas a year. In fact, he argues that a portfolio of a few carefully chosen, well-understood companies is likely to do much better than a huge, diversified portfolio of companies you know nothing about. The key is to invest only in what you understand. This is one of Lynch's most famous principles. He calls it the know-nothing defense. If you don't understand how a company makes money, if you can't explain its business to a 5th grader in 2 minutes, then you have no business owning its stock. This simple rule will protect you from the most common and dangerous investment mistakes, such as buying a hot but complex biotech or software company whose products are a complete mystery to you. Your circle of competence is your greatest defense. Modern takeaway. This chapter's advice is a vital counterpoint to the YOLO culture of modern trading. The internet is full of stories of people betting their entire life savings or even taking out loans to invest in a speculative meme stock or cryptocurrency. This is the exact opposite of Lynch's advice. He would be horrified by this level of recklessness. His counsel to only invest money you can afford to lose is a timeless principle of risk management that is being ignored by a new generation of gamblers. His point about investing within your circle of competence is also more important than ever. The modern market is filled with incredibly complex companies. Think about the semiconductor industry, with companies like NVIDIA and AMD, or the world of cloud computing, with companies like Amazon Web Services and Microsoft Azure. If you don't work in the tech industry, it can be almost impossible to understand the competitive dynamics and technological advantages of these companies. Lynch would not tell you to avoid these stocks. He would tell you to be honest with yourself. If you are a software engineer, you have a massive edge in understanding these businesses. If you are a history teacher, you probably don't. In that case, you should focus your research on areas you do understand. Maybe it's a publishing company, a restaurant chain, or a manufacturer of a product you use every day. This chapter is a call for humility and self-awareness. Know your limits. Play within your own field of expertise and never, ever bet the rent money. Part 2, Picking Winners. Chapter 6, A Trip to the Mall. Lynch opens a core section of his book by putting his "by what you know" philosophy into practice. He takes the reader on a metaphorical, and for him, often literal, trip to the mall. This chapter is a detailed, anecdotal guide to how you can use your everyday experiences as a consumer to generate winning stock ideas. He argues that the mall is a fantastic laboratory for investment research. It's a place where you can see capitalism in action, where you can observe which brands are hot and which are not. He says that for years, he got some of his best ideas simply by walking to the mall with his wife or kids. He would notice which stores were crowded and had long checkout lines. He would see what brands his teenage daughters were excited about. These were powerful, real-time indicators of company success, long before that success would show up in their quarterly earnings reports. He gives the example of the Gap. He noticed that their stores were always packed. He liked the quality and price of their clothes. He did some more research, found that the company was expanding rapidly and had a strong balance sheet, and it became a huge winner for the Magellan Fund. The initial idea came not from a Wall Street report, but from a simple observation as a consumer. He encourages the reader to become an active observer in their own life. When you are out shopping, don't just be a passive consumer. Be an investigator. Which stores have the most buzz? Are the parking lots full? Do the products seem like a good value? Are the employees helpful and motivated? He also stresses the importance of understanding the difference between a local success and a national growth story. A single popular restaurant in your town is a good start, but the 10-bagger potential comes from asking the next question. Is there room to grow? If that successful restaurant has a plan to open hundreds of new locations across the country, then you might be onto something big. He gives the example of Taco Bell, which he noticed was a simple, profitable, and easily replicable concept. It was a national growth story in the making. This chapter is a fun, accessible, and incredibly practical guide to generating ideas. Lynch is empowering the reader, showing them that they don't need to be a Wall Street insider to find the next big thing. They just need to be an observant and curious shopper. Modern takeaway. While the traditional shopping mall may be less central to our lives today, the principle of this chapter is more powerful than ever. The mall is now the internet. It's our social media feeds, our e-commerce habits, and the subscription services we use every day. The streaming wars. A modern Lynch would have paid close attention to the rise of Netflix. He would have noticed that everyone was binge-watching their shows. He might have asked his friends, "Are you still paying for cable?" The answers would have pointed him toward a massive shift in media consumption, e-commerce dominance. He would have been an early user of Amazon Prime, marveling at the convenience and the growing power of its ecosystem. He would have been a customer of Shopify-powered stores, noticing the explosion of independent online brands. The rise of niche brands. Think of a company like Yeti. A modern Lynch might have been a fisherman or a camper who noticed that everyone was suddenly using these expensive but incredibly high-quality coolers. He would have asked, why are people paying $300 for a cooler? The answer would have led him to a powerful, high-margin brand with a cult-like following. Social media trends. He would have paid attention to which platforms his kids and their friends were using, watching the rise of Snapchat, TikTok, and the incredible engagement on platforms like Roblox. This chapter is a call to be a Scuttlebutt investor in the digital age. Read the customer reviews on Amazon. Look at what brands are trending on Instagram. Pay attention to the subscription services you can't live without. Your own behavior as a consumer is a treasure map of potential investment ideas. Chapter 7, The 6 Categories. This is one of the most important and useful chapters in the entire book. Lynch argues that before you can analyze a stock, you must first know what kind of stock you are dealing with. A stock is not just a stock. He breaks the entire universe of companies down into 6 distinct categories. Understanding which category a company falls into is crucial because it tells you what to expect from it and, more importantly, what to watch for. Here are Lynch's 6 categories. Slow growers. These are large, mature companies that are growing at about the same rate as the overall economy, 2 to 4% a year. Think of giant utility companies. They are not going to be 10-baggers, but they are generally stable and pay a regular, generous dividend. You buy these for the income, not for growth. Stalwarts. These are large, well-known blue-chip companies that are still growing, but at a more moderate pace, 10 to 12% a year. Think of companies like Coca-Cola or Procter & Gamble. They are not going to be explosive winners, but a 30 to 50% gain over a couple of years is a reasonable expectation. These are solid, defensive holdings for a portfolio, especially during a recession. Fast growers. This is Lynch's favorite category and the main hunting ground for 10-baggers. These are small, aggressive, new companies that are growing at a rapid pace, 20 to 25% a year or more. They're often in fast-growing industries. These stocks are risky, as some of them will flame out, but a single big winner can make up for several small losers. Cyclicals. These are companies whose sales and profits rise and fall in a regular or cyclical pattern. Think of auto companies, airlines, and steel companies. They do well when the economy is strong and get crushed during a recession. Timing is everything with cyclicals. Buying them at the top of the cycle can be devastating. Turnarounds. These are companies that have been beaten down and battered, but have a chance to make a comeback. It could be a company that was on the brink of bankruptcy but has a new management team, or a company that has a single great product that can save it. These are high-risk, high-reward plays, and their performance is not correlated with the broader market. Asset plays. These are companies that are sitting on a valuable asset that the market has overlooked. The asset could be a huge pile of cash, a valuable portfolio of real estate, or a hidden division that is worth more than the entire company's market cap. This is a classic value investing approach. Lynch stresses that companies can change categories over time. A fast grower can eventually mature into a stalwart, and a stalwart can decline into a slow grower. The investor's job is to correctly categorize the stocks they own and understand the story and the expectations that go along with each category. Modern takeaway. The 6-category framework is a timeless and incredibly useful tool for any investor. Let's apply it to the modern market. Slow growers. A company like AT&T would be a classic slow grower. It's a massive, mature business with slow growth, but it pays a high dividend. Stalwarts. Apple and Microsoft are perfect modern examples. They are giant, dominant companies, but they're still managing to grow their earnings at a solid 10 to 15% a year. They're the blue-chip anchors of a modern portfolio. Fast growers. The tech sector is full of these. A company like NVIDIA in its earlier days, or a more recent software-as-a-service SaaS, a company like Snowflake or CrowdStrike would fit this description. These are the companies with potential for explosive returns, but also with high risk and high valuations. Cyclicals. The semiconductor industry, with companies like Micron Technology, is highly cyclical. The auto industry, including both Ford and Tesla, is also a cyclical business tied to consumer spending and the health of the economy. Turnarounds. A company like Meta, Facebook, in late 2022 could be seen as a turnaround story. The market had lost faith due to its massive spending on the metaverse, and the stock crashed. Investors who bet on a comeback and a return to discipline were handsomely rewarded. Asset plays. These are harder to find but still exist. Sometimes an activist investor will get involved in a company to force it to sell off a valuable but overlooked division, unlocking the hidden asset value. By using Lynch's framework, a modern investor can build a more balanced and intelligent portfolio. You can understand that you shouldn't expect the same performance from your AT&T stock as you do from your small cap tech stock. Each has a different role to play. The streaming wars. A modern Lynch would have paid close attention to the rise of Netflix. He would have noticed that everyone was binge-watching their shows. He might have asked his friends, "Are you still paying for cable?" The answers would have pointed him toward a massive shift in media consumption and e-commerce dominance. He would have been an early user of Amazon Prime, marveling at the convenience and the growing power of its ecosystem. He would have been a customer of Shopify-powered stores, noticing the explosion of independent online brands. The rise of niche brands. Think of a company like Yeti. A modern Lynch might have been a fisherman or a camper who noticed that everyone was suddenly using these expensive but incredibly high-quality coolers. He would have asked, "Why are people paying $300 for a cooler?" The answer would have led him to a powerful, high-margin brand with a cult-like following. Social media trends. He would have paid attention to which platforms his kids and their friends were using, watching the rise of Snapchat, TikTok, and the incredible engagement on platforms like Roblox. This chapter is a call to be a Scuttlebutt investor in the digital age. Read the customer reviews on Amazon. Look at what brands are trending on Instagram. Pay attention to subscription services you can't live without. Your own behavior as a consumer is a treasure map of potential investment ideas. Chapter 7, The 6 Categories. This is one of the most important and useful chapters in the entire book. Lynch argues that before you can analyze a stock, you must first know what kind of stock you're dealing with. A stock is not just a stock. He breaks the entire universe of companies down into 6 distinct categories. Understanding which category a company falls into is crucial because it tells you what to expect from it and, more importantly, what to watch for. Here are Lynch's 6 categories. Slow growers. These are large, mature companies that are growing at about the same rate as the overall economy, 2 to 4% a year. Think of giant utility companies. They're not going to be 10-baggers, but they're generally stable and pay a regular, generous dividend. You buy these for the income, not for growth. Stalwarts. These are large, well-known, blue-chip companies that are still growing, but at a more moderate pace, 10 to 12% a year. Think of companies like Coca-Cola or Procter & Gamble. They are not going to be explosive winners, but a 30 to 50% gain over a couple of years is a reasonable expectation. These are solid, defensive holdings for a portfolio, especially during a recession. Fast growers. This is Lynch's favorite category and the main hunting ground for 10-baggers. These are small, aggressive, new companies that are growing at a rapid pace, 20 to 25% a year or more. They are often in fast-growing industries. These stocks are risky, as some of them will flame out, but a single big winner can make up for several small losers. Cyclicals. These are companies whose sales and profits rise and fall in a regular or cyclical pattern. Think of auto companies, airlines, and steel companies. They do well when the economy is strong and get crushed during a recession. Timing is everything with cyclicals. Buying them at the top of the cycle can be devastating. Turnarounds. These are companies that have been beaten down and battered, but have a chance to make a comeback. It could be a company that was on the brink of bankruptcy but has a new management team, or a company that has a single great product that can save it. These are high-risk, high-reward plays, and their performance is not correlated with the broader market. Asset plays. These are companies that are sitting on a valuable asset that the market has overlooked. The asset could be a huge pile of cash, a valuable portfolio of real estate, or a hidden division that is worth more than the entire company's market cap. This is a classic value investing approach. Lynch stresses that companies can change categories over time. A fast grower can eventually mature into a stalwart, and a stalwart can decline into a slow grower. The investor's job is to correctly categorize the stocks they own and to understand the story and the expectations that go along with each category. Modern takeaway. This 6-category framework is a timeless and incredibly useful tool for any investor. Let's apply it to the modern market. Slow growers. A company like AT&T would be a classic slow grower. It's a massive, mature business with slow growth, but it pays a high dividend. Stalwarts. Apple and Microsoft are perfect modern examples. They are giant, dominant companies, but they are still managing to grow their earnings at a solid 10 to 15% a year. They are the blue-chip anchors of a modern portfolio. Fast growers. The tech sector is full of these. A company like NVIDIA in its earlier days, or a more recent software-as-a-service, SaaS. A company like Snowflake or CrowdStrike would fit this description. These are the companies with the potential for explosive returns, but also with high risk and high valuations. Cyclicals. The semiconductor industry, with companies like Micron Technology, is highly cyclical. The auto industry, including both Ford and Tesla, is also a cyclical business, tied to consumer spending and the health of the economy. Turnarounds. A company like Meta, Facebook, in late 2022 could be seen as a turnaround story. The market had lost faith due to its massive spending on the metaverse, and the stock crashed. Investors who bet on a comeback and a return to discipline were handsomely rewarded. Asset plays. These are harder to find but still exist. Sometimes an activist investor will get involved in a company to force it to sell off a valuable but overlooked division, unlocking the hidden asset value. By using Lynch's framework, a modern investor can build a more balanced and intelligent portfolio. You can understand that you shouldn't expect the same performance from your AT&T stock as you do from your small-cap tech stock. Each has a different role to play. The hottest stock in the hottest industry. This is Lynch's #1 rule of avoidance. When a company is the darling of Wall Street, when it is featured on the cover of magazines, and when every analyst is breathlessly recommending it, it is almost always a sign that the stock is overowned, overanalyzed, and dangerously overvalued. He gives the example of the disk drive industry in the 1980s, which was a hot, high-growth area. Dozens of companies went public, and their stocks soared. But the competition was so brutal that almost all of them eventually went bankrupt. The hot industry became a graveyard for investors' capital. Beware the next something. When you hear a company being touted as the next Microsoft, the next Amazon, or the next McDonald's, run in the other direction. These comparisons are usually a sign of lazy analysis and hype that a great company is unique. It succeeds on its own merits, not by being a copy of something else. Diversification. This is Lynch's brilliant term for companies that diversify into businesses they don't understand and have no business being in. A successful hotel company that suddenly decides to buy an oil exploration business is likely to destroy shareholder value. He prefers companies that stick to their knitting and focus on what they do best, the whisper stock. These are companies with a vague, exciting story about a revolutionary new product that is going to change the world, but they have no sales and no profits yet. The story is often complex and hard to understand, which makes it sound more impressive. Lynch says that if you can't understand what the company does, you can't intelligently invest in it. Beware the middleman. Companies that are heavily reliant on a single, large customer are in a precarious position. If they lose that one customer, their business can be wiped out overnight. The stock with the exciting name. This is the flip side of his dull name rule. Companies with exciting, high-tech sounding names, e.g. Cyberoptics or Nanogen, are often more story than substance. They are designed to attract naive investors. Modern takeaway. This list of red flags is a perfect guide to avoiding the biggest bubbles and manias of the modern era. Hottest stock in the hottest industry. Think of the 3D printing craze around 2013, the cannabis stock bubble of 2018, or the disruptive innovation bubble of 2021, epitomized by the ARK Invest funds. In all these cases, a hot industry narrative led to insane valuations and, ultimately, a devastating crash for investors who bought at the peak. The next something. Every week in the crypto world, a new project is launched and is hyped as the next Bitcoin or the Ethereum killer. Almost all of them end up being worthless. The same happens in the electric vehicle space, where dozens of startups have been touted as the next Tesla, only to burn through their cash and fail. Diversification. Meta's Facebook's massive multi-billion-dollar pivot into the metaverse could be seen by a Lynch-style investor as a potential case of diversification. The market certainly treated it that way in 2022, punishing the stock for taking its focus off its core, highly profitable social media business, the whisper stock. The SPAC boom of 2020 to 2021 was the ultimate breeding ground for whisper stocks. Dozens of pre-revenue companies, from electric vehicle startups to flying taxi companies, went public at multi-billion-dollar valuations based on nothing more than a PowerPoint presentation and a grand story about the future. The vast majority of them have since collapsed. This chapter is your shield. By learning to recognize these classic red flags, you can protect your portfolio from the most dangerous and speculative parts of the market, freeing up your capital and your mental energy to focus on real, durable investment opportunities. Chapter 10. Earnings, earnings, earnings. In this chapter, Lynch gets down to the numbers. He says that while the story of a company is crucial, it is nothing without the financial results to back it up. And the single most important number to focus on is earnings. He explains that a stock's price will, over the long run, follow the trajectory of its earnings. If a company's earnings are consistently growing, its stock price is highly likely to go up. If its earnings are stagnant or declining, its stock price is likely to go nowhere or down. It's that simple. He says that you can look at a chart of a company's stock price and a chart of its earnings per share, and they will almost always look like a pair of dancing partners, moving in tandem. This leads him to one of his key valuation tools, the price-to-earnings PE ratio. The PE ratio is simply the company's stock price divided by its annual earnings per share. It's a quick measure of how expensive a stock is. A high PE ratio means you are paying a high price for the company's current earnings, which implies you are expecting high growth in the future. A low PE ratio means the stock is cheaper relative to its earnings. Lynch is not a deep value investor who only buys stocks with very low PE ratios. He is happy to pay a higher PE for a company with a faster growth rate. This is where he introduces a concept of the PG ratio, although he doesn't call it that in this chapter. He says that you should compare the PE ratio to the company's earnings growth rate. If you have a company with a PE of 20 and an earnings growth rate of 20% a year, that is a reasonable valuation. But if the company has a PE of 40 and a growth rate of only 10%, it is dangerously expensive. He wants the growth rate to be at least equal to the PE ratio. He also stresses the importance of understanding the difference between a one-time jump in earnings and a sustainable trend. He advises you look at the long-term track record of earnings growth to see if it is consistent and reliable. The bottom line of this chapter is that earnings are the engine that drives a stock. Your job as an investor is to find companies with a strong and growing stream of earnings and to make sure you don't pay too high a price for that stream. Modern takeaway. The focus on earnings is a timeless principle that gets lost in today's hype-driven markets. During the 2021 bubble, many investors were buying story stocks with no earnings at all based on metrics like projected revenue growth or total addressable market. Lynch would call this pure speculation. He would insist on seeing a track record of actual, real profits before investing. The relationship between price and earnings is still the most powerful force in the market. Look at a company like Nvidia. Its stock price has had an incredible run over the last decade. Why? Because its earnings have been growing at an explosive rate, driven by the booms in gaming, crypto mining, and now artificial intelligence. The stock price has simply followed the earnings. The PE ratio remains the most commonly used valuation metric. A modern Lynch-style investor, using a tool like the PEG ratio, PE divided by growth rate, would be able to quickly screen for stocks that offer growth at a reasonable price. They would look for a PEG ratio of 1 or less. This simple tool would have kept them out of the most absurdly valued tech stocks in 2021, many of which were trading at PEG ratios of 3, 4, or even 5. This chapter is a call to get back to basics. Don't be seduced by a good story. Check the numbers. If the earnings aren't there, you should probably move on. Chapter 11, the 2-minute drill. After finding a promising idea and checking the earnings, Lynch has a final, simple test he puts a stock through before he gets serious about the research. He calls it the 2-minute drill. It's a quick monologue where he tries to summarize the case for owning a particular stock. He says you should be able to explain, in 2 minutes or less, in simple, everyday language, exactly why you're interested in this company. The explanation should sound sensible to a 5th grader. It should cover a few key points. What does this company do? Why is it good business? Is it a fast grower? A stalwart? A turnaround? What is the story that will drive its earnings higher in the future? Are they expanding into a new market? Do they have a great new product? What are the potential pitfalls? What could go wrong with the story? If you can't give this quick, coherent summary, it's a sign that you don't really understand the investment. You are likely buying it based on a vague hope or a hot tip. Lynch says that he would often perform this monologue out loud to himself. The act of verbalizing the story would immediately reveal any holes in his logic. He gives some examples. For a company like La Quina Motels, the 2-minute drill might sound like this. La Quina is a fast-growing chain of motels. I've stayed in them, and they are clean and convenient. They are expanding across the Sun Belt, a fast-growing region. They have a consistent record of earnings growth, and the stock is selling at a reasonable PE ratio. The risk is that a recession could hurt the travel business. It's simple, it's logical, and it shows that he understands the core of the investment thesis. This 2-minute drill is not a substitute for deep research. It is a prerequisite. It is a filter you use to separate the truly promising ideas, which you will then research in depth from the half-baked, speculative ones. It is a powerful tool for enforcing intellectual discipline and ensuring that you are only investing in businesses you truly understand. Modern takeaway. The 2-minute drill is an incredibly powerful exercise for the modern investor who is constantly bombarded with complex and often confusing investment ideas. Try applying it to a modern asset class like cryptocurrency. Can you explain, in 2 minutes, in simple terms, what Cardano or Solana actually does? What is its unique value proposition? What is the story that will drive its adoption and therefore its price higher? If your explanation evolves into a string of incomprehensible jargon about proof-of-stake protocols and decentralized oracles, it's a sign that you may not understand investment as well as you think you do. The same test can be applied to any stock. Before you buy Palantir, can you give a 2-minute drill on what their software does and why a company would choose them over a competitor? Before you buy a speculative biotech stock, can you explain how their new drug works and what the odds are of it passing its clinical trials? This simple exercise is a powerful defense against FOMO. When a stock like GameStop is soaring, the temptation to buy is immense. But if you force yourself to do the 2-minute drill, you will quickly realize that the story is not about the company's business fundamentals. The story is about a short squeeze, a social media phenomenon. This allows you to recognize it for what it is, a speculation, not a fundamental investment. By forcing yourself to articulate the why behind every purchase, you can save yourself from your own worst impulses. Chapter 12. Getting the facts. Once a stock has passed the 2-minute drill, it's time to do the real homework. In this chapter, Lynch walks the reader through the practical steps of researching a company. He demystifies the process, showing that it doesn't require a finance degree, just a bit of curiosity and effort. His primary source of information is the company's annual report. He jokes that more people read the Bible in a year than read annual reports. But for an investor, the annual report is a holy text. He advises you to get a copy. In his day, you had to call the company and ask for it. Today, you can download it instantly online and focus on a few key areas. The story section. The front part of the report with the pictures and the letter from the CEO tells you what the company does and what its plans are for the future. You should read this with a skeptical eye, as it is a marketing document, but it gives you a good overview of the business. The balance sheet. This is the most important part for Lynch. He is obsessed with the company's financial strength. He wants to see a lot of cash and not a lot of debt. He has a simple rule of thumb. A strong balance sheet has at least twice as much equity as it is debt. He is particularly wary of bank debt, which can be called in at any time, as opposed to long-term bond debt. A company with a strong balance sheet can survive a recession or a period of trouble. A company with a weak balance sheet is fragile. The income statement. This is where you look at the long-term track record of earnings. Are they growing consistently? What are the profit margins? Beyond the annual report, Lynch is a huge believer in kicking the tires. This is his Scuttlebutt method in action. If it's a retail company, go to the stores. If it's a restaurant, eat the food. If it's a product, try it out. This real-world research can give you insights that you will never find in a financial statement. He also advises talking to the company itself. He says that the investor relations department is one of the most underutilized resources for the amateur investor. You can call them and ask them questions about their business. You might be surprised by how much they are willing to tell you. The goal of all this research is to build a complete picture of the company. You want to understand its story, its financial health, and its growth prospects better than the average analyst on Wall Street, who is probably just looking at a spreadsheet. Modern takeaway. The process of getting the facts is easier today than ever before. All of a company's financial filings, like the 10K annual report and the 10Q quarterly report are available for free on the SEC's EDGAR database or on financial websites like Yahoo Finance. You can screen for companies with the characteristics Lynch likes, such as low debt-to-equity ratios. But Lynch's emphasis on kicking the tires is still the key to finding a real edge. Researching a tech company before investing in a software company like Monday.com or Asana, you can sign up for a free trial of their product. Is it easy to use? Does it solve a real problem? Read the reviews on software review sites like G2 or Capterra. Researching consumer brand before investing in a company like Lululemon, go to the store, feel the quality of the product, observe the customers. Are they passionate about the brand? Look at the company's Instagram page. Is it building a strong community? Researching a video game company before investing in Roblox, download the app and see what the experience is like. Watch YouTubers who stream the game. Understand why it is so popular with kids. The internet has made Scuttlebutt research incredibly powerful. You can become an expert on almost any company from your laptop. This chapter is a call to go beyond the ticker symbol. Be a detective. The deeper your understanding of the business, the greater your conviction will be, and the more likely you are to hold on to the market's inevitable ups and downs. Chapter 13. The numbers you need to know. This chapter is a user-friendly guide to the key financial metrics that Lynch uses to evaluate a stock. He strips away the complexity and focuses on a handful of simple, powerful numbers that can tell you a lot about a company's health and valuation. Here are some of Lynch's favorite numbers. Percent of sales. When looking at a specific product or division within a company, always ask, what percentage of total sales does it represent? A hot new product is exciting, but if it only accounts for 1% of the company's revenue, it's not going to have a big impact on the stock price. The P/E ratio, price to earnings, as discussed before, this is his go-to valuation metric. He uses it to get a quick sense of whether a stock is cheap or expensive. He compares a company's P/E to its own historical range and to the P/E of its competitors. The P/G ratio, P/E to growth rate, this is Lynch's secret weapon for valuing growth stocks. He calculates it by taking the P/E ratio and dividing it by the company's earnings growth rate. A P/E-G ratio of 1, e.g., a P/E of 20 and a growth rate of 20%, is a fair price. A P/E-G ratio of 0.5 is a bargain. A P/E-G ratio of 2 or more is dangerously expensive. This simple tool helps him avoid overpaying for growth. The balance sheet. He revisits the balance sheet, focusing on cash and debt. He likes to see more cash than long-term debt. He calculates the net cash per share, cash minus debt, divided by the number of shares, to see how much of a company's stock price is backed by hard cash, dividends. For stable, mature companies, he pays close attention to the dividend. Does the company have a long history of paying and raising its dividend? A company that cuts its dividend is a major red flag. However, for a fast-growing company, he is happy for them to pay no dividend and reinvest all their profits back into the business. Book value. He is generally skeptical of book value as a measure of a company's worth, as it can be misleading. However, for an asset play company, it can be very important. Cash flow. Lynch is a huge fan of free cash flow. This is the cash a company generates after all its expenses and capital expenditures. It's the real cash that can be used to pay dividends, buy back stock, or fund growth. He says that cash is king, and a company with strong and growing free cash flow is a healthy company. Inventory. For retail and manufacturing companies, he pays close attention to the inventory levels. If inventory is growing much faster than sales, it's a major red flag. It means the company's products aren't selling, and they might have to slash prices to get rid of the excess inventory, which will kill their profits. Lynch's approach to the numbers is that of a practical business analyst, not an accountant. He is looking for simple, common-sense indicators of a company's health and value. Modern takeaway. All of these metrics are readily available on any major financial website today. An amateur investor can build a simple checklist based on this chapter to evaluate any stock. The P/E-G ratio. This is an incredibly useful tool for navigating the often frothy valuations of modern tech stocks. In 2021, many popular software stocks were trading at P/E ratios of 100 or more, while their growth rates were only 30 to 40%. Their PEG ratios were 3 or higher, a clear sign of overvaluation according to Lynch's method. This would have kept you out of the subsequent crash. Net cash. Look at the balance sheets of giants like Apple, Google, and Microsoft. They are sitting on hundreds of billions of dollars in net cash. This financial fortress is a huge competitive advantage and provides a massive margin of safety for investors. Inventory. This metric was a key warning sign for many retail and tech companies in 2022. Companies like Target and even the chipmaker Nvidia saw their inventories swell as post-pandemic demand slowed down. This was a signal that trouble was ahead, and their stock prices fell accordingly. Cash flow. The modern market has come to appreciate the importance of free cash flow, especially for tech companies. A company that can grow rapidly without burning through cash is seen as a much higher quality business than one that relies on constant fundraising to survive. This chapter gives the amateur investor a powerful but simple toolkit for financial analysis. You don't need to be a math genius. You just need to know what few numbers really matter. Chapter 14, Rechecking the Story. In this chapter, Lynch emphasizes that stock picking is not a one-time event. You don't just buy a stock and forget about it. You must continuously monitor the story. The world changes, industries evolve, and a company's fortunes can turn on a dime. The investor's job is to stay on top of the story and to know when it has changed for the better or for the worse. He recommends checking in on your companies every few months. This doesn't mean watching the stock price every day. It means rechecking the fundamentals. He suggests a simple routine. Read the latest quarterly and annual reports. Is the company still growing its earnings? Is the balance sheet still strong? What is the company saying about its future prospects? Go back and perform your 2-minute drill. Is the story you told yourself when you bought the stock still true? He then breaks down what to watch for in each of his 6 categories. Slow growers. The main thing to check is that the dividend is still safe and that the company hasn't taken on a lot of new debt. Stalwarts. Check the P/E ratio. Have a lot of institutions discovered the stock and push its valuation too high? Watch out for diversification. Cyclicals. This is all about monitoring the business cycle and the inventory levels. The first sign of the cycle turning is your signal to get out. Fast growers. This requires the most monitoring. The key is the growth rate. Is the company still growing at a rapid pace? Are they successfully expanding into new markets? The first sign that a fast grower's growth is starting to slow down is a major red flag. Turnarounds. The only thing that matters here is whether the turnaround is actually happening. Is the new management team cutting costs? Is the new product selling well? Is the company returning to profitability? Asset plays. Has the company started to unlock the hidden asset value? Are they selling off that valuable division? If not, is there still a catalyst that will make it happen? The key takeaway is that you are not just a stock owner. You are a part owner of a business. And as a business owner, you need to stay informed about how your business is doing. Modern takeaway. The need to recheck the story is more critical than ever in our fast-changing world. A company's competitive advantage can be eroded much more quickly today than in Lynch's time. The disruption of Stalwarts, a company like Netflix, was a fast grower for years. But as new, deep-pocketed competitors like Disney+, HBO Max, and Amazon Prime Video entered the streaming market, the story changed. The industry became much more competitive, and Netflix's growth started to slow. An investor who was not rechecking the story would have been caught by surprise when the stock price collapsed. The cyclical nature of tech. Many investors learned the hard way in 2022 that even some tech companies are cyclical. A company like Peloton was a fast grower during the pandemic, but it turned out to be a cyclical beneficiary of the stay-at-home trend. When the world reopened, the story completely fell apart. The turnaround bet on Meta, an investor who bought Meta, Facebook, in late 2022 as a turnaround play, would have needed to monitor the story closely. They would have been watching for signs that Mark Zuckerberg was cutting costs, that the core advertising business was stabilizing, and that the stock buyback was continuing. These were the key elements of the turnaround story. This chapter is a call for ongoing diligence. Your initial research is just the price of admission. The real work and the real profits come from staying on top of the story over the long haul. Chapter 15, the final checklist. This chapter serves as a comprehensive summary of the entire stock picking process. Lynch provides a final checklist of things to review before you buy stock and what to think about after you bought it. It is a practical point-by-point guide that brings all of his previous concepts together. Before you buy, understand the company's business. You must know what it does and what its prospects are. Categorize the stock. Is it a stalwart, a fast grower, a cyclical? This sets your expectations. Check the earnings. Is the company profitable? Is the P/E ratio reasonable relative to its growth rate? Check the balance sheet. Is it strong or weak? How much debt does it have? For slow growers, check the dividend. Is it consistent? For cyclicals, check the inventory levels. For fast growers, make sure it can replicate its success. Can it continue to grow? Do you have local knowledge? Do you have some edge in understanding this company? After you buy, things to keep in mind. Don't get scared out of a stock by a market decline. If the company's story is still good, a price drop is an opportunity. To buy more, don't over-diversify. Owning a few stocks you know well is better than owning many you know nothing about. Recheck the story regularly. At least every 6 months. Know your selling criteria. Have a clear idea of why you would sell the stock. Is it because the story has deteriorated? Or because the stock has become massively overvalued? This checklist is the culmination of the entire Picking Winners section. It is a disciplined, repeatable process that any investor can follow. It is designed to maximize your chances of finding a winner and, just as importantly, to minimize your chances of getting hurt by a loser. It is the practical application of Lynch's entire philosophy. Modern takeaway. This checklist is a timeless tool that can be used by any modern investor to bring structure and discipline to their process. It can be turned into a simple spreadsheet or a note in your phone that you review before making any investment decision. Before buying a stock like Tesla, a Lynch-style investor would go through the checklist. Category: fast grower or cyclical. Earnings: are they growing? PE and PEG ratio: is the valuation insane? Balance sheet: is it getting stronger? The story: can they continue to dominate the EV market? This structured process prevents an emotional, hype-driven purchase. After buying a stock, the advice to know your selling criteria is crucial for managing modern, volatile stocks. If you buy a fast-growing software stock, your selling rule might be, I will sell if the revenue growth rate drops below 20% for 2 consecutive quarters. This gives you an objective reason to exit, preventing you from holding on and hoping as a former star performer fades away. In a world that encourages impulsive, one-click trading, Lynch's final checklist is a powerful call for slowing down, being methodical, and thinking like a professional. It is the bridge from being a gambler to being a true stock picker. Part 3, the long-term view. Chapter 16, designing a portfolio. In the final part of the book, Lynch moves from the art of picking individual stocks to the science of constructing and managing a portfolio. He offers practical advice on how many stocks to own, how to allocate your money among them, and how to think about the overall structure of your investments. One of his key arguments is against the idea of over-diversification. The conventional wisdom often says that you should own dozens or even hundreds of stocks to be safe. Lynch thinks this is a terrible idea for the amateur investor. He calls it diversification. If you own 100 stocks, you can't possibly keep up with the stories of all of them. And even if one of them becomes a 10-bagger, it will have such a small impact on your overall portfolio that it won't make a meaningful difference. He says, if you want to be safe, buy a mutual fund. For the individual stock picker, he suggests owning a more concentrated portfolio, perhaps between 3 and 10 stocks. This is a manageable number. It allows you to do the deep research required for each company and to stay on top of their stories. In a portfolio of this size, a single big winner can have a massive, life-changing impact. He also suggests allocating your money based on your conviction and the type of stock. You might have a larger position in a can't-miss stalwart that you understand well, and a smaller, more speculative position in a risky fast grower or a turnaround. He advises against putting an equal amount of money in every stock, as not all ideas are created equal. He also talks about the importance of patience in portfolio management. He says that you shouldn't feel the need to be fully invested all the time. If you have done your research and you can't find a single company that meets your criteria and is selling an attractive price, it is perfectly fine to hold your money in cash and wait. He says, there's always something to worry about, but there is not always a bargain to be found. Waiting for the fat pitch is a key part of the game. Modern takeaway. Lynch's advice on portfolio construction is a direct challenge to the modern trend of index and forget investing, which is central to the FIRE movement. He is not against ETFs for people who don't want to do the work. But for those who do, he is a passionate advocate for a more concentrated, active approach. A modern Lynch-style investor would not just own the S&P 500. They might own a core position in an ETF and then have a fun portfolio of 5 to 10 individual stocks that they have researched deeply, where they are hunting for 10-baggers. His advice against over-diversification is also highly relevant. Many new investors on Robinhood will buy tiny, fractional shares of dozens of different companies. They end up with a portfolio that looks like a miniature index fund, but without the low cost and with none of the benefits of concentration. Lynch would say they are better off finding 3 companies they absolutely love and understand, and making more meaningful bets on them. The idea of holding cash is also a powerful but often forgotten strategy. In the bull market of 2021, there was immense pressure to be fully invested at all times. Cash is trash was a common refrain. A Lynch-style investor, seeing the frothy valuations across the board, might have patiently held a large cash position. This would have not only protected them from the 2022 crash, but would have also given them the dry powder to buy their favorite companies at bargain prices during the downturn. This chapter is a masterclass in professional portfolio management. Be concentrated, be patient, and don't be afraid to wait for the perfect opportunity. Chapter 17, when to buy and, more important, when to sell. This chapter is one of the most practical and valuable in the entire book. Lynch addresses the 2 questions every investor struggles with: when to buy and when to sell. He argues that people spend 99% of their time figuring out what to buy, and almost no time developing a disciplined strategy for when to sell. This, he says, is a huge mistake. When to buy. Lynch's advice on buying is simple. Buy when you've found a great company with a great story, and its stock is selling at a reasonable price. He is not a market timer. He doesn't believe in trying to buy at the absolute bottom. He is happy to buy a stock after it has already gone up, as long as the story and the valuation still make sense. He often bought stocks that were making new highs, as this was a confirmation of their strength. When to sell. This is the core of the chapter. Lynch provides a detailed category-by-category guide for when to sell a stock. His reasons for selling are always tied to a change in the fundamental story, not to the stock's price movement. Sell a slow grower when the stock's price has appreciated significantly, e.g., 30 to 50%, and the PE is now well above its normal range, or when a company starts to lose market share and its fundamentals deteriorate. Sell a stalwart when the stock's PE gets too high relative to its peers, or when a new product that was a source of excitement turns out to be a dud. Also, sell if you find more attractive stalwart with better prospects. Sell a cyclical when the cycle is reaching its peak. Watch for rising inventories and falling commodity prices. Sell when things look rosiest, because that's usually when the cycle is about to turn. Sell a fast grower when the explosive growth begins to slow down. Watch for signs like slowing same-store sales or expansion into unrelated businesses, diversification. Also, sell when the stock's valuation becomes truly absurd, e.g., a PEG ratio of 3 or more. Sell a turnaround when the turnaround has been successful and the company's business is back to normal. At this point, it is no longer a turnaround, and you should reevaluate it based on its new category, likely a stalwart or cyclical. Sell an asset play when the company has unlocked the value of the asset, e.g., sold off the division, or when an outside force, like an activist investor, has come in and pushed the stock price up to reflect the asset's value. He also provides a list of terrible reasons to sell a stock, such as the stock has gone up, so I must take a profit, or the stock is down, so I should sell before it goes lower. These are emotional, price-based decisions. Lynch insists that you should only sell when the story of the business has changed for the worse. Modern takeaway. This disciplined, story-based selling framework is a powerful tool for navigating modern markets. Selling a fast grower. Think of a stock like Netflix. For years, its story was about explosive subscriber growth. A Lynch-style investor would have held it. But when the company's own forecast started to show that subscriber growth was slowing dramatically due to increased competition, that was a fundamental change in the story. That was a signal to sell, regardless of where the price was. Selling is cyclical. An investor in a semiconductor company like Micron would have been watching for signs that the chip cycle was peaking in 2021. News of the glut in memory chips and rising inventories would have been the signal to sell. Long before the stock price collapsed in 2022, selling a turnaround. An investor who bought Meta as a turnaround in late 2022 would have a clear selling thesis. Sell when the cost-cutting is complete and the market once again values the company as a stable advertising giant. This chapter provides a clear, logical, and unemotional framework for selling. In a world where most investors sell based on fear, panic selling a crash, or greed, selling a winner too early, this fundamental, story-driven approach is a revolutionary advantage. Chapter 18. The 12 silliest and most dangerous things people say about stock prices. In this humorous but hard-hitting chapter, Lynch takes on the common, lazy, and often disastrous cliches that people use to justify their investment decisions. He lists 12 common sayings about stock prices and debunks them one by one. This is a masterclass in avoiding sloppy thinking. Here are a few of the silliest things he debunks. If it's gone down this much, it can't go any lower. Lynch says this is one of the most dangerous ideas in finance. He points out that a stock that goes from $10 to $2 has lost 80% of its value, but it can still go from $2 to zero, which is another 100% loss. There is no floor on how low a stock can go. If it's gone this high, it can't go any higher. The flip side is equally foolish. He says that his greatest winners were stocks that kept hitting new highs for years. A rising price is often a sign of strength, not a reason to sell. Eventually, they always come back. This is the bag holder's prayer. Lynch points out that many great companies of the past simply disappeared. They went bankrupt or were rendered obsolete by new technology. There is no rule that says a fallen stock must eventually recover. It's $3 a share, what can I lose? He explains that whether a stock is $3 or $300 is irrelevant. What matters is the company's market capitalization. A $3 stock could still be massively overvalued. And if it goes to zero, you lose 100% of your money, the same as if a $300 stock goes to zero. Look at all the money I've lost. I didn't buy it. This is the pain of regret and FOMO. Lynch says you can't lose money on a stock you don't own. Wasting mental energy on your ones that got away is a useless distraction. I'm waiting for a pullback. While it sounds prudent, this can often lead to missing a great winner entirely. The truly explosive growth stocks often never have a significant pullback until a major move is over. By dismantling these common cliches, Lynch is trying to force the reader to think more critically and specifically about their investments. He wants you to replace these lazy, general rules with a deep and specific understanding of the company you own. Modern takeaway. These silly sayings are more prevalent than ever today, amplified by social media. It can't go any lower. This was the mantra of people buying crashing story stocks like Peloton or Zoom all the way down in 2022. They were catching a falling knife, and they learned the hard way that a stock can always go lower. They always come back. This is the hope that sustains many cryptocurrency communities after a major crash. While Bitcoin has come back from multiple 80% drawdowns, thousands of other altcoins have gone to zero and will never come back. It's only a few cents. What can I lose? This is a logic that drives the speculation in penny stocks and low-priced shitcoins. People throw money at them because they are cheap on a per-share basis, without any regard for the underlying value or the high probability of losing their entire investment. Look at all the money I've lost. The regret of not buying Bitcoin at $1,000 or Tesla at $20 is a powerful and destructive emotion that fuels a lot of the FOMO-driven buying at market tops. This chapter is a mental hygiene checklist. Read through this list and be honest with yourself. How many of these silly things have you said or thought? By identifying and eliminating this kind of sloppy thinking, you can dramatically improve your investment discipline and your long-term results. Chapter 19, options, futures, and shorts. In this brief chapter, Lynch gives us thoughts on the more exotic financial instruments like options, futures, and short selling. His tone is one of extreme caution. He is not a fan of these instruments for the amateur investor. Options and futures. Lynch acknowledges that these can be used by professionals for complex hedging strategies, but he knows that for the average person, they are almost always used for pure leverage gambling. He points out that the vast majority of options expire worthless, and the amateur who buys them is in a race against time, faded decay. He says that if you are right about a stock, you will make plenty of money just by owning the stock itself. You don't need the extra leverage and complexity of options, which can turn a correct idea into a losing trade if your timing is slightly off. Short selling. Lynch himself was not a short seller. His philosophy was focused on finding great growth stories on the long side. He sees shorting as a dangerous and difficult game. When you buy a stock, the most you can lose is 100% of your investment. But when you short a stock, your potential loss is theoretically infinite, as there is no limit to how high a stock can go. He also points out the psychological difficulty of shorting. You are betting against the market's natural upward bias and against the inherent optimism of human nature. His overall message is simple: stick to what you know. For the vast majority of people, this means buying and owning the common stock of good companies. The world of derivatives and short selling is a professional's game, and the amateur who wanders into it is likely to get hurt badly. Modern takeaway. This chapter is an incredibly important warning for the modern retail trader. The gamification of trading on platforms like Robinhood has made it incredibly easy for beginners to start trading stock options. The allure of turning a few $100s into thousands with a single well-timed call option is immense. But as Lynch warned, this is a losing game for most. The apes on Wall Street bets famously use options to make their YOLO bets, and while the wins are celebrated publicly, the far more numerous and catastrophic losses are often hidden. The same applies to the leveraged futures contracts that are so popular in the cryptocurrency markets. A new trader can easily get 100x leverage on their Bitcoin position. This means a tiny 1% move against them can wipe out their entire account. This is not investing. It is high-speed gambling. Lynch's skepticism of short selling is also a timeless lesson. Think of the professional hedge funds who were shorting GameStop and Tesla. They had a sound fundamental thesis, but they were run over by a wave of irrational exuberance, and their losses were catastrophic. If even the pros can get destroyed on the short side, the amateurs should be doubly cautious. This chapter is a call for simplicity. You can build a massive fortune just by buying and holding the stocks of great companies. You don't need to play in the dangerous and complex world of derivatives. Chapter 20. 50,000 Frenchmen Can't Be Wrong. In this chapter, Lynch takes on the psychological comfort of following the crowd. The title comes from an old saying, and Lynch's point is that in the stock market, 50,000 Frenchmen or 1 million Reddit users can be and often are completely wrong. He argues that there is a tendency for both amateurs and professionals to find safety in numbers. If everyone is buying a certain stock, it feels safer to buy it too. If no one is interested in a company, it feels risky to be the only one who is. This is herd mentality, and it is the enemy of superior investment returns. Lynch says that some of his best and most profitable investments were the ones that were the most lonely. They were stocks that no one else wanted, that were out of favor, and that he was buying all by himself. His 10-bagger in Chrysler, a classic turnaround, was a stock that most professionals wouldn't touch with a 10-foot pole. His willingness to go against the crowd and trust his own research was the source of his greatest successes. He advises the reader to be a contrarian. When the experts in the media are all in agreement about something, you should be skeptical. When everyone is euphoric about a can't-miss stock, that is often the time to be most cautious. Conversely, when everyone is pessimistic and there is blood in the streets, that is often the time of maximum opportunity for the brave and well-researched investor. He concludes that you cannot make superior returns by making conventional decisions. If you want to beat the market, you must be willing to think differently from the market. You must be willing to look foolish in the short term to be right in the long term. This requires a strong stomach and a deep conviction in your own independent work. Modern takeaway. The power of the herd is stronger today than ever before. thanks to social media. The meme stock phenomenon is a perfect example. Millions of people bought AMC and GameStop not because they had done a deep analysis of the companies, but because it was a popular thing to do. They were part of a movement, a community. They were the 50,000 Frenchmen. And while some have gotten early made money, the majority who bought at the peak, when euphoria was at its highest, suffered massive losses. Look at all the money I've lost. I didn't buy it. This is the pain of regret and FOMO. Lynch says you can't lose money on a stock you don't own. Wasting mental energy on your ones that got away is a useless distraction. I'm waiting for a pullback. While it sounds prudent, this can often lead to missing a great winner entirely. The truly explosive growth stocks often never have a significant pullback until a major move is over. By dismantling these common cliches, Lynch is trying to force the reader to think more critically and specifically about their investments. He wants you to replace these lazy, general rules with a deep and specific understanding of the company you own. Modern takeaway. These silly sayings are more prevalent than ever today, amplified by social media. It can't go any lower. This was the mantra of people buying crashing story stocks like Peloton or Zoom all the way down in 2022. They were catching a falling knife, and they learned the hard way that a stock can always go lower. They always come back. This is the hope that sustains many cryptocurrency communities after a major crash. While Bitcoin has come back from multiple 80% drawdowns, thousands of other altcoins have gone to zero and will never come back. It's only a few cents. What can I lose? This is a logic that drives the speculation in penny stocks and low-priced shitcoins. People throw money at them because they are cheap on a per-share basis, without any regard for the underlying value or the high probability of losing their entire investment. Look at all the money I've lost. The regret of not buying Bitcoin at $1,000 or Tesla at $20 is a powerful and destructive emotion that fuels a lot of the FOMO-driven buying at market tops. This chapter is a mental hygiene checklist. Read through this list and be honest with yourself. How many of these silly things have you said or thought? By identifying and eliminating this kind of sloppy thinking, you can dramatically improve your investment discipline and your long-term results. Chapter 19, Options, Futures, and Shorts. In this brief chapter, Lynch gives us thoughts on the more exotic financial instruments like options, futures, and short selling. His tone is one of extreme caution. He is not a fan of these instruments for the amateur investor. Options and futures. Lynch acknowledges that these can be used by professionals for complex hedging strategies. But he knows that for the average person, they are almost always used for pure leverage gambling. He points out that the vast majority of options expire worthless, and the amateur who buys them is in a race against time, theta decay. He says that if you are right about a stock, you will make plenty of money just by owning the stock itself. You don't need the extra leverage and complexity of options, which can turn a correct idea into a losing trade if your timing is slightly off, short selling. Lynch himself was not a short seller. His philosophy was focused on finding great growth stories on the long side. He sees shorting as a dangerous and difficult game. When you buy a stock, the most you can lose is 100% of your investment. But when you short a stock, your potential loss is theoretically infinite, as there is no limit to how high a stock can go. He also points out the psychological difficulty of shorting. You are betting against the market's natural upward bias and against the inherent optimism of human nature. His overall message is simple. Stick to what you know. For the vast majority of people, this means buying and owning the common stock of good companies. The world of derivatives and short selling is a professional's game, and the amateur who wanders into it is likely to get hurt badly. Modern takeaway. This chapter is an incredibly important warning for the modern retail trader. The gamification of trading on platforms like Robinhood has made it incredibly easy for beginners to start trading stock options. The allure of turning a few $100s into thousands with a single well-timed call option is immense. But as Lynch warned, this is a losing game for most. The apes on Wall Street bets famously use options to make their YOLO bets, and while the wins are celebrated publicly, the far more numerous and catastrophic losses are often hidden. The same applies to the leveraged futures contracts that are so popular in the cryptocurrency markets. A new trader can easily get 100x leverage on their Bitcoin position. This means a tiny 1% move against them can wipe out their entire account. This is not investing. It is high-speed gambling. Lynch's skepticism of short selling is also a timeless lesson. Think of the professional hedge funds who were shorting GameStop and Tesla. They had a sound fundamental thesis, but they were run over by a wave of irrational exuberance, and their losses were catastrophic. If even the pros can get destroyed on the short side, the amateurs should be doubly cautious. This chapter is a call for simplicity. You can build a massive fortune just by buying and holding the stocks of great companies. You don't need to play in the dangerous and complex world of derivatives. Chapter 20, 50,000 Frenchmen Can't Be Wrong. In this chapter, Lynch takes on the psychological comfort of following the crowd. The title comes from an old saying, and Lynch's point is that in the stock market, 50,000 Frenchmen or 1 million Reddit users can be and often are completely wrong. He argues that there is a tendency for both amateurs and professionals to find safety in numbers. If everyone is buying a certain stock, it feels safer to buy it too. If no one is interested in a company, it feels risky to be the only one who is. This is herd mentality, and it is the enemy of superior investment returns. Lynch says that some of his best and most profitable investments were the ones that were the most lonely. They were stocks that no one else wanted, that were out of favor, and that he was buying all by himself. His 10-bagger in Chrysler, a classic turnaround, was a stock that most professionals wouldn't touch with a 10-foot pole. His willingness to go against the crowd and trust his own research was the source of his greatest successes. He advises the reader to be a contrarian. When the experts in the media are all in agreement about something, you should be skeptical. When everyone is euphoric about a can't-miss stock, that is often the time to be most cautious. Conversely, when everyone is pessimistic and there is blood in the streets, that is often the time of maximum opportunity for the brave and well-researched investor. He concludes that you cannot make superior returns by making conventional decisions. If you want to beat the market, you must be willing to think differently from the market. You must be willing to look foolish in the short term to be right in the long term. This requires a strong stomach and a deep conviction in your own independent work. Modern takeaway: the power of the herd is stronger today than ever before, thanks to social media. The meme stock phenomenon is a perfect example. Millions of people bought AMC and GameStop not because they had done a deep analysis of the companies, but because it was a popular thing to do. They were part of a movement, a community. They were the 50,000 Frenchmen. And while some who got in early made money, the majority who bought at the peak, when euphoria was at its highest, suffered massive losses. Psychological pressure forces people to abandon their judgment and buy at absurd prices. A modern Lynch-style investor would use this herd behavior as a contrarian indicator. When they see a crypto coin with laser eyes in every Twitter profile, or a stock that is trending on Wall Street bets, they don't see it as a signal to buy. They see it as a signal that the trade is overcrowded and that the risk of reversal is extremely high. They would be looking for the opportunities that no one is talking about, the boring but profitable companies that are being ignored while the crowd is chasing the latest fad. This chapter is a call to courage. Have the courage to stand alone. Chapter 21, a final word. In his final brief chapter, Lynch offers a few concluding words of encouragement. He reiterates his core belief that the stock market is not a scary or mysterious place. It is a logical and understandable system where the rewards go to those who do their homework. He encourages the reader not to be intimidated by the short-term ups and downs of the market. He reminds us that corrections and bear markets are a normal part of the process. They are not something to be feared, but something to be prepared for, and even welcomed as an opportunity to buy great companies at bargain prices. He finishes with a simple, powerful, and optimistic message. You have what it takes to be a successful investor. The resources are all around you. The ideas are in your local mall, in your workplace, and in the products you use every day. The information is readily available in company reports and online. The only thing standing between you and investment success is a little bit of effort and the courage to think for yourself. It is a fitting and empowering end to a book that is, from start to finish, a celebration of the power and potential of the individual investor. Modern takeaway. In a world that often feels complex, chaotic, and stacked against a little guy, Lynch's final message of optimism and empowerment is more valuable than ever. The modern market, with its algorithms, its institutional dominance, and its social media manias, can feel intimidating. Lynch's final word is a reminder that the fundamental game has not changed. It is still about finding good businesses. And the individual, with their unique local knowledge and freedom from institutional constraints, is better equipped to play that game than ever before. His encouragement to embrace market declines is also a crucial lesson for a generation of new investors who may have only experienced a bull market. The brutal bear market of 2022 was a shock to many. Lynch's wisdom provides a psychological fortitude to endure these periods and to see them not as a disaster, but as a sale of a lifetime. This final chapter is a send-off. Lynch has given you the map, the tools, and the encouragement. Now it's up to you to start the journey, to become your own stock picker, and to take your rightful place as a successful and independent investor. Modern context expansion. What would Peter Lynch say today? Let's bring the legendary Peter Lynch into our hyper-connected, meme-driven, algorithm-fueled 21st century market. What would the master of Scuttlebutt, and by what you know, think of the world we live in now? He would be both incredibly excited and deeply concerned. The internet, the ultimate scuttlebutt tool. Lynch would be like a kid in a candy store with the internet. In his day, scuttlebutt meant physically going to stores, calling investor relations departments, and reading trade magazines. Today, he could do the research of 100 analysts from his home office. Spotting trends. He would be an avid user of Google Trends to see the rising popularity of a brand. He would scour Reddit forums, not for stock tips, but to read what real, passionate customers are saying about a product. He would watch TikTok to see what brands are going viral with the next generation. He would see social media as the world's biggest and most honest focus group. Company research, the ability to instantly download any company's annual report, listen to their earnings calls online, and watch video interviews with their CEO would be a dream come true. He would argue that the information gap between the professional and the amateur has been almost completely eliminated. The edge is no longer in access to information, but in the willingness to interpret correctly. The local edge is now global. He would love that an investor in America can now easily kick the tires on a European or Asian company. You can read reviews from customers in Germany, watch videos of a store in Japan, and understand a global brand's appeal in a way that was impossible in the 1980s. The internet, he would argue, has made his by what you know philosophy even more powerful. The modern market. New game. Same rules. How would he approach today's dominant themes and strategies? Meme stocks, GameStop, AMC. He would be fascinated and horrified. He would be fascinated by the power of the retail crowd to move markets, seeing it as the ultimate expression of market psychology. But he would be horrified by the complete detachment from fundamentals. He would say, the story is not about the business. It's about the stock itself. This is not investing. It is pure, unadulterated gambling. He would warn that for every person who got rich, 100 who bought at the top would be destroyed. Cryptocurrency. Lynch would approach crypto with extreme caution and immense curiosity. He would not dismiss it outright. His first question would be, do I understand it? He would likely spend months trying to understand the technology and the use case for different projects. He might find an investment story in a platform like Ethereum if he saw it as a new kind of decentralized infrastructure with growing earnings in the form of transaction fees. However, he would be deeply skeptical of coins with no use case, like Dogecoin, seeing them as pure speculation. He would warn that in an industry with no profits and no balance sheets to analyze, the story is everything, and stories can change in an instant. Passive investing, ETFs, and Fire Lynch, the ultimate active stock picker, would have a nuanced view. He would say that for the 95% of people who are not willing to do the hard work of research, a low-cost S&P 500 ETF is a perfectly sensible and probably the best option. He would applaud the discipline of the FIRE movement. However, he would passionately argue that those who are willing to do the work are giving up a massive opportunity by defaulting to passive. He would say, why settle for average when you have the tools to be great? The dangers of the modern world. Lynch would also see new and enhanced dangers for the amateur investor. Information overload. He would warn that while we have more information, we have less time to think. The constant stream of news from CNBC, the endless chatter on Twitter, and the second-by-second P&L updates on our phones create a terrible environment for long-term thinking. He would advise people to turn off the noise and focus on the company's story. The gamification trading. He would despise the Robin Hood culture of treating the market like a video game. He always stressed that a stock is not a lottery ticket. The modern app interface, with its focus on price wiggles and options trading, encourages the worst possible behaviors. Ultimately, Lynch would pound a table and say that his principles are more important than ever. In a world of hype and noise, the simple act of finding a good business you understand and buying it at a reasonable price is a revolutionary act. He would be more optimistic than ever about the potential for the amateur investor to win. Closing reflection, 10 timeless lessons from Wall Street's everyman. As our deep dive into One Up on Wall Street comes to a close, we are left with a feeling of profound empowerment. Peter Lynch did more than just generate incredible returns. He democratized the art of stock picking. He taught a generation of investors to trust their own eyes, their own experience, and their own common sense. Let's distill his folksy wisdom into 10 timeless lessons. Invest in what you know. Your greatest edge comes from your own life. Use your experience as a consumer, a worker, and a hobbyist to find great companies before Wall Street does that. A stock is not a lottery ticket. Behind every stock is a real company. Understand the business, and you will understand the stock. The price will eventually follow the earnings. You have more than enough brains to succeed. Don't be intimidated by the experts. The amateur investor has a set of powerful advantages: flexibility, patience, and local knowledge that can lead to superior results. Do your homework. A stock tip is not a substitute for research. The initial idea is just the beginning. Do the Scuttlebutt, read the annual report, and build your own conviction. Categorize your stocks. Know what you own. A slow grower, a stalwart, and a fast grower are different animals with different expectations. This framework is essential for managing your portfolio. Avoid the hot stock in the hot industry. The biggest winners often come from boring, overlooked, and even disagreeable industries. The place where nobody is looking is often the best place to find a bargain. A market decline is an opportunity. Market crashes are a normal and recurring feature of investing. Don't fear them. Prepare for them. They're the sale of a lifetime for the investor who has a shopping list of great companies. Know your story and know when it changes. Your reason for owning a stock should be based on its fundamental story. Monitor that story. Selling should be based on a negative change in the story, not on a scary price drop. Ignore the big picture. Stop trying to predict the economy, interest rates, or the direction of the market. It's a waste of time. Focus on finding great individual companies, and the long term will take care of itself. Patience is a virtue and a profitable one. The greatest 10 baggers take years to develop. You need the patience to let your winners run. Over-trading and the desire to get rich quick are the enemies of wealth. How can you apply these lessons right now? Start today. The next time you're at the grocery store, at the mall, or at work, start paying attention. What products do you love? What services are making your life better? What companies are your colleagues raving about? Make a list. Then, pick one of those companies and start the 2-minute drill. Can you explain what it does and why it's a good business? If you can, go to its investor relations website and download the latest annual report. Read the story. Look at the balance sheet. Is there more cash than debt? Look at the earnings. Are they going up? This is the Peter Lynch method in action. It's not complex. It's not esoteric. It is a process of applied common sense and curiosity. Lynch's ultimate gift was to give us all permission to believe in our own ability to be great investors. The opportunity is all around you. You just have to open your eyes.